Welcome back to another episode of the Invest Like a Billionaire podcast. We've got a top of mind episode coming at you. These are short and sweet, hitting on one or two topics that are trending right now and things that we're seeing in the market. The big thing that everyone's been following the past few months is what's the Fed going to do with interest rates? They just held rates steady recently. The past week or two, we've seen the long-term rates drop substantially, right? And so that's an indication that the market believes rates are going to be coming down, maybe sooner than expected. And that's kind of added extra optimism and hope to the market. Jerome Powell had some words to say in some things that he wanted us to tamper. So talk about that a little bit, and then we're going to hit on some other recent updates from consumer spending into this holiday season here that's just pretty interesting, but not surprising.
This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors.
Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments so your portfolio is best positioned for this economic environment. Get started and download your free economic report today.
Yeah, Jerome Powell said in a speech just a week ago that the U.S. inflation has come down over the past year, but remains well above our 2% target. My colleagues and I are gratified by this progress and expect that the process of getting inflation sustainably down to 2% has a long way to go. So that sounds, a little bit optimistic. They are definitely not declaring victory, and there's literally no visibility in 2024 on rate cuts. Meanwhile, the market has jubilantly done the happy dance that rates, and the literally long rates started dropping last few weeks, and so markets do the happy dance, and real estate investors are doing the happy dance, but the Fed is not doing a happy dance. So we'll see who's right. But, not a lot of reason to do the happy dance yet. So we'll see.
It's interesting too. I mean, we just had a great conversation with John Chang, which will be coming out in the next couple of weeks on the Thursday.
That was a great interview.
You're definitely going to want to listen to every bit of that. He brought so much insight. But one of the things that
if you're a real estate investor, you want to listen to that podcast.
Yeah.
At Real Estate Economics.
And one of the things he was saying is so interesting. He's like, hey, a lot of the younger, or newer investors in real estate kind of came into the market in the past, 10, 15 years at a very unique time that is truly an anomaly in the course of, 50 plus year history of real estate investing, and really from a debt standpoint, right? In a long-term rate standpoint. And with rates being held close to zero for a long time, and long-term rates being, pretty anemic as well, it really made real estate really easy to pencil, right? But as the rates are kind of higher right now, and then even, higher longer term, relative to longer periods of history, it's not outside the norm. In fact, it's actually, the long-term rates are even lower than historical averages. And so it's just an interesting kind of compare and contrast here with, the market got so used to these incredibly cheap rates, and it's felt like really for past year plus of the rates going up, when is it going to be the first rate cut, right? And people thought it was going to happen sooner or later. And now it's kind of been this, acceptance of, okay, it's probably going to be a little bit longer than we want, but, they can't hold us forever. We're seeing progress. Let's just drop it right away. But it's, what we've been saying for a while, over the past year, 18 months is higher for longer, both inflation and by necessity interest rates being higher for longer, unless there's some kind of, black swan event. But it feels like the market is overreacting again, right? And so Jerome Powell is calling out, don't get too optimistic yet. And, along the same kind of theme, we've been talking about the consumer being very strong, from a savings standpoint, from a real income standpoint. We just got another report from the Wall Street Journal here saying American shoppers have plenty of dry powder. So this is Wall Street Journal. We'll link to both these articles in the show notes here. But talk through some of these charts. They're just really fascinating.
Well, it's, it sounds like, we keep replaying the same themes. So if you've been listening to our podcast, we're not going to have a recession, which we've been saying for almost 2 years now. We're not going to have a recession, or if we do, it's going to be very, very light. And the reason is the consumer is spending like there's no tomorrow. And there was a huge savings glut as well. And so the report just came out, consumer spending on goods is at an all-time high. Inflation adjusted. After adjusting for inflation, it's at an all-time high. Consumers are on fire. And there's a great chart in the article that shows this. And then it says cumulative excess savings held by U.S. households is still at $50 billion. Just what was saved over in the COVID era is still, there still hasn't been spent yet. It's dropping, but there's still money left. And so in spite of low consumer sentiment, which, is probably due to the political impasse and, who knows, high inflation, all these things, but consumers are absolutely on fire. And given that is 70% of the U.S. economy, it's just going to continue to boom along until it doesn't anymore. But there's still runway in this economy. And, the latest numbers out of the GDP, the GDP growth were just revised up over 5% GDP growth. It's nutty. It's nuts what's happening. And so all that says we're probably not going to see rate cuts, I don't think in early 2024. And I think it's probably unlikely anytime in 2024. I'm hopeful. I would like to see rate cuts. We get our mortgages refinanced, and if you miss that boat, I'm sure you're upset by that. But and back to your point, everybody's waiting for the rates to get back to normal. And to John Chang's point on the podcast, what if this is normal? In fact, it is. Higher rates. If this is normal, that the rates dropped to near zero during the great financial crisis, and really during the Obama years, we never quite got out of recession. It just never quite happened. And so rates have just been slow. Then we got hit by the pandemic and they went down to zero again, but I think this is probably closer to normal.
Closer to normal. And, this kind of report from, Wall Street Journal and the consumers dovetails, squarely into the Fed sentiment is, this being, consumer spending is 70% of the economy. In 2023, it's looking like we're going to have a gangbuster GDP growth year, right? And a lot of it's being driven by the consumers. Like, that's going to continue to be inflationary. And so as consumers continue to spend, maybe it slows down a little bit, but there's still, a lot of this excess savings. And despite people being, not very positive sentiment, they're still spending like there's no tomorrow.
We are seeing rent growth slowing. We're seeing oil prices being soft. All those things are going to help the inflation numbers get down. But we've always said, we've never tried to predict inflation over, a 1 quarter or even a 1 year period. But long-term inflation is not going to it's not going to stay down because primarily of wages and energy prices have systemic structural issues, not cyclical issues. So yeah, we're gonna see that. But I do think we might see rates continue to inflation start to continue to soften in the short term, before it continues being stubbornly high.
Yeah, I think as investors, it's always hard to shift your frame of what you've been used to. And we all got accustomed to, which was cheap debt. We loved it, and it made things a lot easier. But we have to now shift the frame. If this is the reality of the next 12 to 18 months, maybe even beyond, there's still opportunity, and you need to shift where you're looking for the opportunity, to shift, how you're positioning, with this is the new normal. And,
right.
There's a lot of indications that this is going to be this way for a little while. And so as investors, we need to, get over the desire for it to be different and go back to the way it was. And
hey, there's opportunities everywhere, and so I don't know if you remember, but when this whole zero interest rate regime kind of became the normal, 10 years ago or so, 15 years ago, all the media was talking about how horrible that was for savers, and it is. I mean, you're a saver. How do you get income? So if you put your money in the stock market, it's a big gamble. But if you're retiring, what do you do? How do you get savings? Well,
right.
You just open an account with Ally Bank, and what is it? Almost 5%? A savings account with an FDIC insured bank? What? Well, that's kind of nice. So there's two sides of every coin, and now it's good for savers, right? It's good for savers, and it should be good for savers. You should be able, money has a value over time, and you should have value over time. So
right.
That's called the interest rate, and so what's good for savers is not good for borrowers, and so shifting back the other way.
Shifting back. All right, guys. Hope you enjoyed this episode, and always appreciate you tuning in. Feel free to share with a friend, and don't miss the next episode. Thanks.